This week's question is from Paula. What's the backdoor Roth IRA and what's the pro rata rule? Welcome to the world of tiny violin problems, my friend.
Let me play a sad song for you on the world's smallest violin.
There are certainly worse problems to have in the personal finance world. Luckily for you, this one can be circumvented with like a little bit of extra legwork. So in 2022, the income limit for investing at all in a Roth IRA is a modified adjusted gross income, or MAGI, which always reminds me of the We Three Kings thing, of $144,000 for singles and $214,000 for married filing jointly. But you can't really take those numbers at face value. Keep in mind, there are deductions that apply to your MAGI, like your contributions to your pre-tax retirement accounts. So you'll start phasing out of contribution eligibility at a MAGI of $129,000 and $204,000 respectively. But since Roth dollars are super valuable, people in higher income brackets sometimes still want to leverage them in addition to their pre-tax contributions to things like 401ks. So what should you do if you fear you're unable to contribute to a Roth IRA because you make too much money? A backdoor Roth IRA. You should be able to pull this off without any tax penalties, but there is one scenario to be aware of that might trigger a tax bill that I'll note at the end. The pro rata rule that you referenced in the question. Clearly, you've been doing some reading. In a backdoor Roth IRA, you basically open a traditional IRA and then you make a non-tax deductible contribution. In other words, you're using money that you've already paid taxes on. So likely means this is money that's just sitting in your checking or your savings account. Obviously, at the outset, you're probably like, well, what's the point if the main benefit of this account doesn't work for me? But the ability to convert IRAs from traditional to Roth is the key here. So, number one, you're going to open a traditional account with your brokerage firm of choice. I like Vanguard, M1 Finance, or Betterment, for example. Then you're going to open a Roth IRA with the same firm if you don't have one yet. Third, you're going to fund the traditional IRA up to the IRA contribution limit, $6,000 going up to $6,500 in 2023. And then you're going to leave the funds in the money market cash balance. You're not going to invest them yet. Crucially, you will not claim this as a deduction when you file your taxes. That's the non-deductible part. Number four, you're going to wait a few days for the cash to settle. Now, from what I've read, converting it too quickly can foul up your plan. So I feel like to be safe, you might want to just wait a week. And then number five, you're going to convert the cash to a Roth IRA. Now, big brokerage firms know how to do this. If you need help, you can just ask them. There should, though, literally be a button that says convert to Roth IRA. Number six, because the funds are not invested yet, there will be no gains to pay taxes on. You already have a Roth IRA ready and waiting for you from step one. And then last but not least, you're going to invest in the funds of your choice within the Roth IRA with the money that you just converted. So obviously, that was a lot of steps. Feel free to consult a CPA, but that should give you a general sense for how this works. Now, when should you almost definitely not try this? If you already have traditional IRAs laying around like discarded Fiji water bottles, and I am going to assume you drink Fiji water because, well, you're going to be subject to this convoluted thing called the IRS pro rata rule, which will result in a tax bill. It's a little complicated. The breakdown between your existing pre- and post-tax dollars in your existing traditional IRAs. Now, remember, that includes rollover, SEP, anything that has pre-tax money aside from the 401k. That's going to determine the amount of your conversion that is taxable. For example, if you already have $50,000 in a traditional IRA or a rollover IRA, all pre-tax funds outside that 401k that you created with deductible pre-tax contributions before you were this high roller, and you add another $6,000 to that amount post-tax, with the intention of rolling it into a Roth IRA, $6,000 only represents about 10% of your total amount in all of your traditional IRAs. So that means 10% of your $6,000 conversion to Roth will be tax-free, and you'll be taxed on the other 90%. Money that you guessed it, already paid taxes on since it was non-deductible to begin with. So you'd be paying taxes twice. It's not ideal. TLDR, depending on how much money you've got in those other IRAs and how much you're trying to roll over, it could create a pretty big tax bill come April. So for that reason, I would really only attempt this again on your own without the help of a professional if you do not have a big balance in a traditional rollover or SEP IRA already, and you would just be creating your first one, a fresh one, or if your balances in those accounts are so low that even a full tax hit would not really be that big of a deal.